Stocks are surging today after the U.S. and China agreed to temporarily lower tariffs for 90 days as they work out a final trade deal. We want to talk about how investors should think about the rally within their portfolio. Here with more, we've got Preston Cherry, Concurrent Wealth Management founder and wealth advisor. Preston, good to have you on the program with us. So what do you do with a day like today, coming off of a Sunday two-day meeting concluding here where you have some easing in the pressures for both sides and hopefully some of the cooler heads prevail?
Absolutely. I think you just continue your contributions over time. So investors have a little bit more confidence now with the trade announcement. And nobody likes hearing more of the same during corrections or crashes, but more of the same is good for rallies. So continuing contributions during a rally helps dollar cost averaging. So business owners with paychecks and also professionals with paychecks continues that investing over time and buys at highs and low points and smoothing out that price, that cost basis over time.
What's the number one question that you receive from clients when things are rosy, bright, versus when things are a little bit more tumultuous, unpredictable perhaps, and they're trying to figure out, okay, what should I be doing with my own portfolio strategy at this juncture?
Sure. So when times are bad, the question is, should we go to cash? And when times are good, is should we hold our cash and wait for the next correction or crash? So it's all surrounding around cash, and cash is good for emergencies, liquidity purposes, lifestyle choices, and during times of uncertainty. That said, cash doesn't earn the market return, historical market returns. Inflation eats up that cash. And if you continue to stay invested, then you can capture the best performing days historically after low historically performing days.
With all of this in mind, are you too late if stocks are already rallying on a day like today?
The worst behavioral finance behavior is FOMO, so fear of missing out. Actually, last year, there were 57 new highs in the market. So this question came up often. Do we hold our cash and wait for the next crash? Well, with 57 new highs, last year, there were 62 new market highs in 2017. So when the market has good momentum and there's not as much uncertainty in the market and the economy, then the market historically tends to keep the momentum and go higher.
And so with that in mind, how do you kind of best gauge what your exposure should be coming out of or even in the midst of times where the markets are more volatile, and how you start to selectively pick areas where for the long term you feel comfortable being invested in?
Yes, folks should always consider their risk capacity, their risk tolerance, and their goals, and have an intentional investing plan in order to help them maintain that good investing behavior. And also, too, there's opportunities in the market. For example, we're looking at Delta. Delta is consumer discretionary during times of uncertainty. Then folks are looking at their pockets. They're going to pull back their travel budgets. And Delta did not list any guidance in their last call. In their market, their stock went down about 25+%. Now you have new tariff announcements on the positive side, and folks are saying, I have a little bit more confidence to re-engage with my budgets, and now Delta is up 25, 27%.
Preston, as best indicator as it has been for risk on sentiment, Bitcoin is back in the ballpark of some of its highs here. So what should investors do with that information if they're trying to figure out what the broader sentiment, what the bullish or animal spirits are that might prevail in the equities market?
Yes, with Bitcoin, cryptocurrency as a whole, folks call that decentralized finance and the market's traditional finance. And usually, or nowadays, they're acting kind of the same. So with the crypto coin investors, they have more of a belief system in that particular structure, which is different from, say, printing money, so to speak. That said, there's a lot of correlation there in those two areas. However, in the Bitcoin and crypto space in general, lots of volatility. So peel off a small portion of your overall portfolio, say 5, 7, 10%, in order to gain exposure to those volatile areas if it fits your risk capacity and goals, and invest that way, not your whole entire portfolio.
Preston, just lastly, while we have you, we have two companies that could be bellwethers both for the consumer and Walmart's capacity, and then for the semiconductor trade in Nvidia. And neither one of them has reported yet. We're going to hear from Walmart, and then later on in May, we're going to hear from Nvidia. What are your anticipations for what these two earnings bellwethers could signal to the markets?
I think Walmart is a steady as they go type of company, particularly when you have uncertainty and lack of confidence in the overall market. We have political risk, we have economic risk with the trade on and offs. So folks are going to be watching their spending plans over time, and people are trading or swapping out their Target visits or higher income grocery store or consumer needs and wants to more bargain elements like Walmart. So I think Walmart will stay consistent with higher foot traffic. And Nvidia, when those type of companies have those innovative mindsets and also moats around them, protective moats, have good cash flow. So when the market has a little bit more confidence in there, then I expect those companies like Nvidia to rally.
Preston, great to see you again. Thanks so much for taking the time here with us.
I appreciate it. Thank you.